Welcome to Market Monday, in this case Market Tuesday, brought to you by the investment team in the trust department at the First National Bank. We're going to kick things off with the economic reports expected over the next couple of weeks, as we always do, but we'd like to note that we're entering a very interesting period of the year. Typically, whenever any volatility events have started of any consequence, they tend to come in the months of September and October, statistically speaking. March will get an honorable mention. We've had a fair number of them begin in March as well, but with that said, the potential for turbulence historically exists in the fall season. And that is important because we're seeing signs that the economy is changing in its pattern of growth. Not that it's decelerating completely into a stall or negative growth, a decline, but that the pace of growth, it may be starting to slow. And we say may be because the information is still coming in a conflicted manner. Yes, there is signs that the labor market might be slowing down its pace of growth, but it's still showing growth. There are signs that inflation might be slowing down growth, but the numbers are still growing. It's still positive growth. So does that suggest a weakening economy? Not necessarily. And this is important because the narrative among the media and the analyst community all suggests that the Fed is, looking at this as signs that the economy is weakening and that they need to lower rates. Whereas the Fed is stating openly in numerous places that they're taking a data-driven approach and they're watching how these numbers come out and they want to calibrate the timing of their action very precisely. They don't want to be too quick and they don't want to be too late when they do it. So, we're watching the numbers, the same numbers that the Fed is watching, to get a read as to what we think is likelier than not to happen. Obviously, the probabilities all point toward this rate cut being a near certainty, if not a certainty, for September's meeting, but we just don't know that yet. So just this morning we got information that suggests that consumer confidence came in a good bit stronger than expected. We have manufacturing that declined by more than expected. These are conflicting messages, not really meaningful in and of themselves, but this is important. Consumer confidence leads to consumer spending, and consumer spending is 2/3 of GDP growth. We'll get GDP, and that's expected to be unchanged. No revision there. We're expecting the core PCE number to show flat on the quarter-on-quarter annualized basis. That's not inflation coming down. That's inflation staying the same, and it's staying near 3%. So we want to pay attention to that. The Fed certainly is. We're seeing income and spending numbers coming out later. Notably, it's expected to show that spending is increasing. That's a sign of increasing economic activity or growth in GDP. We'll get information on the outlook. Sentiment indicator, the University of Michigan sentiment indicator. We'll get information on the manufacturing sector, durable goods, which is a demand figure, and then labor market information. Productivity is a relatively important number to watch, but the change in non-farm payrolls is going to be probably one of the main events over the next couple of weeks. That is expected to show growth of 160,000 jobs. That's the analyst average expectation, and that would be a significant rise from the prior period's 114,000 jobs created. So when we look at that, that's not suggestive of weakness in the labor market. Neither is a decline by 0.1% in the unemployment rate, which is shown to be expected as well, down to 4.2%. Anything below 5% is considered to be a tight labor market, or at least tighter than the long-term, sustainable average unemployment rate of 5%. So, we're going to be watching these things. So is the market. So is the Fed, certainly. And let's talk about the market. So the market is back up to all-time highs and basically treading water. Most likely, it's treading water in anticipation of the events that are expected at the next Fed meeting, and people being unwilling to really radically change positionings ahead of that. We might see that change because we are in the middle of earnings season. There are companies reporting significant earnings. Some of those companies are a significant portion of the S&P. Therefore, they might be market moving in that sense. But we're not expecting a lot of activity over the next couple of weeks unless those numbers, the economic numbers, come in radically unexpected fashions. And looking at, the way volatility might or might not increase. We referenced volatility at the beginning of this program, let's talk about it in a little more depth. A few Mondays ago, we had an enormous spike in volatility. This VIX volatility index measures options activity and how investors are essentially buying protection. And this spiked to a level not seen except twice in history. Once was 2008 financial crisis, when everything was at the height of it. And, that was a time when everyone thought the whole system was about to collapse. The other time was in 2020, where we were going through the COVID crisis. And again, they thought the whole system was going to collapse at that time. Volatility has subsequently come down, and the media was quick to jump on the fact that, oh, wow, this spike in the VIX signals that you're safe now, that all of the volatility is washed out of the market and the market can continue to march up without any issues. We don't think so. We think that maybe the possibility exists that volatility spike was the beginning of a volatile season and a warning shot over the bow, as opposed to the crescendo and the finale of volatility in the near term. So it remains to be seen, but we say, we're going to keep watch for it because there are a number of factors that could cause the markets to fall. That being the Federal Reserve, if it decided to go well against all expectations and not cut rates in September, to a bad earnings season from many companies, to a seriously deteriorating economy. Any of those things could lead to issues and choppiness in the market. Over the long term, it's not something that's going to be a problem, but in the short term, we're advising clients to, be on the lookout for turbulence and just be aware that it's possible in the upcoming future. Let's talk about interest rate futures and the Fed funds target rate. So basically, this model takes positioning in the interest rate futures market and distills out of that a probability that's implied by this positioning of what the next acts of the Fed are going to be at various meetings. This is giving us odds of a rate cut above 100% at the next two meetings, actually the next 3, 4, 5 meetings. We don't think that you really in the real world ever get 100% odds of anything, and therefore these numbers are probably skewed, and therefore if there is a disappointment, that could add to a volatile or turbulent situation. But on the other hand, these numbers are generally in line with what reality turns out to be. So we have a pretty high confidence that in fact the Fed is going to cut the rates, even though technically they're not seeing the evidence that they need to. We're going to talk a little bit more about that right now. Let's talk about their recent statements. So this is just in bullet point form, a couple of key points that were taken from the recent press release at their last meeting, and then recently from the Jackson Hole speech last Friday. And they're saying, policy expectations, in other words, what Wall Street and the trading community appear to be expecting from the Fed, however measured, point to a first rate cut at the September FOMC meeting, and at least one more cut later in the year and further policy easing next year. So they're openly acknowledging that markets are thinking that they're going to cut. They say that recent data suggests that labor markets conditions are easing. Average non-farm payroll gains in the second quarter were smaller than the average pace seen in the first quarter and over the previous year. That is true. However, if you take the average over the whole data set, they're in line with average. So that's something to watch. They're talking about credit card balances slowing down, which suggests slower spending, which would be slower GDP growth, or at least lead to it. They're saying, and this one's pretty key, the risks around the forecast for real activity were viewed as skewed to the downside, both because more persistent inflation could result in tighter financial conditions than the baseline, and because the recent softening in some indicators of labor market conditions might be pointing to a larger than anticipated slowdown in aggregate demand growth. Let's translate that to English. They're saying that, hey, we're seeing a little bit more risk to the downside in the economy. On the upside, risk to inflation, they see those as having diminished, and when they put the two of those things, the labor market risks and the inflation risks, into context together, they say that they view those risks as balanced. Now it says further that members agreed that they did not expect that it would be appropriate to reduce the target range until they had gained greater confidence that inflation is moving sustainably, that's a key word, toward 2%. That says that they're going to be watching the data and they're not so keen to make any moves early. And just at Jackson Hole Friday, it was said, quote, "The time has come for policy to adjust. The direction of travel is clear, and the timing and pace of rate cuts will depend on incoming data, the evolving outlook, and the balance of risk. So nothing new was said there, yet the headlines all read virtual certainty that the Fed is going to cut rates. We don't think it's that much of a virtual certainty. However, we do think that the odds are pretty high. That said, here's the corporate rate curve. Investors are getting paid 5% for short-term money, 4.5% up into 5% over the rest of the curve. And treasuries are now below 4%, anywhere, 3 years, 2 years and out, all the way out to like 15 years. We're below that, or 14 years. So with that, rates have clearly come down a little bit, but this is interesting. This move up on the longer end of the curve suggests that inflation risk premiums over the long term have, risen. There's only really one pricing issue when you have the U.S. government treasury, and that's the inflation risk or duration risk. And that's the risk that your purchasing power erodes due to inflation. So that's the big thing in there. If that yield is going up, it's not a default risk premium, it's the inflation risk premium is rising over the longer term. And this suggests that market participants think that we're in for an era of higher interest rates and inflation. That said, what does that mean for the longer term in your portfolio? Probably not a lot. Markets have done well over the longer term. We've had a lot of volatility events, some of which were major. And, what we're expecting now, if we do see any volatility this fall, is unlikely to be of that magnitude. We have long-term plans that we adhere to. We don't make changes to those long-term plans based on short-term events. So, we're in it for the long term. Disciplined investing is what's going to win the day. And, hopefully you found this video useful. If you have any questions, if you have any concerns and want to talk about the markets or your portfolio, feel free to give us a call. We love to talk about these things. Thanks. Have a great day.